Hello and welcome along to the PPW pod, bringing you news, views and interviews from the real estate marketplace and prop tech industry. While I have your attention, we are still pretty new, so any help with the algorithm in the form of likes, subscribes, comments, or even reviews are very much appreciated. My name is Edmund Keith. I'm the editor of onlinemarketplaces.com. Joining me for today's episode are Harvey Hancock, who is Online Marketplaces writer. Hello, Harvey.
Hello, Ed. Great to be back. Looking forward to this one.
And Online Marketplaces chairman, Simon Baker. How are you doing, Simon?
I'm very well, thanks. Good morning, Ed. Harvey, great to see you guys again.
Now, over recent weeks, we've spoken quite a lot about challenger portals, specifically about CoStar and Homes.com and on the market. What we haven't really been talking about much, and actually neither has anybody else in the industry, are the number two portals out there, the portals that challengers will have to overtake to complete their missions, right? So today we're going to be talking about Zoopla in the UK, about Realtor.com in the US, and about Domain in Australia. Harvey, why don't we begin with Zoopla? Why don't you give us some background on Zoopla?
Yeah, sure. What's it like to be a silver medalist in the real estate portal world? So, as everyone knows, UK number one, Rightmove, but people don't know a lot about Zoopla. It wants to do the portal game ever so slightly differently to Rightmove. It wants to generate more revenue for you as a buyer by selling you adjacent services. It wants to be a bit more tech savvy, a bit hipper. It gives you valuation tools, gives you housing price indexes that Zoopla releases once a quarter, I think, maybe even a bit more regularly than that. It invests specifically in prop techs, so it's trying to build almost like its own investment arm into, sweeping up, vacuuming up the best incoming prop techs for the industry. But the problem with Zoopla is that it's struggling, basically. It's not been profitable since 2022, as far as we're aware. Made a 7 million loss in 2022. At the same time, Rightmove was making a profit of 250 million, right? Or revenues, at least. No, net profits, 250 million. And now it's got a bit harder for them yet again, because as we all know, on the market, the number three is now owned by the American portal giant CoStar. So that is a company worth 36 million, and it is more than willing to invest some of that money into making OTM the number two player in the UK. Zoopla was bought by a US private equity firm, Silver Lake, for $3 billion in 2018. And if I were CoStar, I'd be looking up maybe a cut price deal and seeing if I could unify the number three and the number two in the UK to really take on Rightmove. That's sort of Zoopla in a nutshell. And over to Ed and Simon for a bit more information.
Okay, so we've been looking at some of the numbers around these portals. There's actually an analysis article that will be out on onlinemarketplaces.com by the time this podcast goes out. Rightmove makes, I think, almost 4 times the revenue of Zoopla, and it has about 3 times the traffic, right? It's worth $6 billion in terms of market cap, in terms of dollars, that is. What do you think, Simon? What do you estimate that Zoopla is worth, given all of that, and given the fact that Silver Lake paid $3 billion for it back in 2018?
Well, the short answer is less than what they paid for it, significantly less. I think what if having you guys have sent me through some numbers here and having a quick look, and that Zoopla seems to be doing 80 odd million pounds in revenue per year, which is substantially less than Rightmove. And when you look at valuing one of these sort of businesses, you have to look at it from a number of dimensions. One is the underlying growth. Is that 80 million in revenue, but it's up from 40 million a few years earlier, so it's got a good growth trajectory. And the second is it'll always be worth a discount to whatever the market leader is in terms of multiples. So first of all, if you look at the numbers here, 2016 Zoopla was doing 80 million, 2017 was about 80 million, 2018 was nearly 90 million, but 2020 is about 80 again, and we're still in 2022. So the business really hasn't gone anywhere from a revenue perspective in the last, sort of 6-7 years. That's the first indicator that your multiple is going to not be so great. The second thing is, you look at a Rightmove, and a Rightmove's trading at something like 13 times revenue and 17 times EBITDA. Well, if you're losing money, an EBITDA multiple is irrelevant. So you look at a revenue multiple. Well, you're not going to get 13 times 80 million odd revenues. You might get 8 to 10. We'll talk about Domain later on, but Domain gets 6 times revenue, whereas REA gets 16 times revenue. So let's call it, for argument's sake, 10 times revenue. That's 800 million pounds, or about, what's that, about 1.2 billion US dollars. That's a substantial discount off a 3 billion price tag. So any which way you cut it, Silver Lake, if they did choose to sell it, will take a haircut, a massive haircut. That's the first thing, right? So what's it worth? Then, the question is, even if you did have it, what would you do with it? Okay, and I think one of the things that is interesting to explore, and Harvey, you really touched on it there in your intro, is that they sort of be doing a bit of a jack of all trades. They're doing many, many different things, from finance to removal services to the traditional advertising and lead generation for agents and so on. And I think that's something you find is quite common in these number twos around the world, is they're looking for an angle, any angle to grow. But if you're CoStar coming in and attacking them via on the market, what do you do? Well, the answer is, if you're Zoopla, you got to get back to the real core of why you were there in the first place, which is all around generating leads for agents, being a viable number two, providing a better user experience than Rightmove, so that the consumers continue to come to the site. I think if you stick to that knitting and go very hard, then you have a chance of survival, moving back into profitability, dump all those jack of all trade things that you're doing that are probably costing you money, and thus you can then, whatever profit you've got, having done all that, you just reinvest into marketing to try to force on the market to spend even more money as a number three to market. That's the challenge, right? Is you're now, as Zoopla, looking both upwards at Rightmove and downwards at on the market, and trying to find a way to aggressively compete with them.
Okay, I want to dig in a little bit to the finances around Zoopla. I'm actually going to share my screen while I do this. Quick caveat before we say anything here. We are going to be talking a bit about publicly traded real estate portals here. None of this is financial advice, obviously. I'm actually the last person that you should take financial advice from. I've lost a lot of money on all of these companies. But I want to dig into this, Simon. So we're looking at a spreadsheet now with some research that I've done for this article. And we can see Zoopla here has got a debt to cash ratio of 27. That is to say, it owes $1.4 billion. It has cash reserves of $55 billion. That's way above the other two companies that we're looking at. Before we came on today, you said that's not such a big issue. Why is that?
So when you look at that and you go, well, there's 1.5 billion in debt, that's clearly not relating to operations. Okay. Right. It clearly, and I don't know the deals that were done originally, but my guess is that when Silver Lake acquired Zoopla back in 2018, it did through some sort of convertible note or some sort of instrument that ends up being a debt-like instrument on the books of Zoopla. Okay, that's how I would do it, which is different to just a straight acquisition of the equity. So it would have been some sort of structuring. So I'm not worried about that, because at the end of the day, when they sell it, that is, and they sell the company for whatever they sell it for, that debt is the first thing that's repaid as part of the transaction. It's just a way in which they can get their money back.
Okay, so having been in charge of one of these companies, you wouldn't be too worried about just having a look at these ratios, comparing them to your competitors or to other similar businesses out there in the world, and seeing your number a lot higher, right?
No, because the question is, who do they owe the debt to? If the debt is owed to the owner of the company, then it's just a way in which, and depending on the interest rate attached to it, it's just a way in which they are, extracting some of the value out of the business. If the debt was owed to a bank and interest rates are going up, then you might have a different view on it all. But I would be absolutely astounded, and you can see by these numbers, about how much they've lost, is that they're clearly not needing 1.5 billion to exist. They're not building out some sort of technology network or infrastructure, and they've had to borrow heavily from banks to put, cell phone towers up everywhere. It's just a different type of debt. This is a debt to actually fund the acquisition of the company. So no,
Okay.
I wouldn't be worried about that.
Okay, fair enough. We'll move on. Like I said,
Before
we've been
we
talking
move
a lot.
on, Ed, do
Go
you
on.
mind if I jump in just a sec? Simon, you were talking about what to do with Zoopla. I was just doing some research while you were talking, and obviously Zoopla Property, ZPG, Zoopla Property Group Property Division, has been rebranded as Houseful last autumn, and that owns a lot of brands including Alto, Dupix, Calcasa, Mojo, HomeTrack, and Prime Location. So all things being used by agencies around the UK. Is there a lot of pulling power to brands like this that are being used by widely across agency networks across the UK that are going to add value to Zoopla because they are closely connected to the tech and the programs and the apps and the platforms that agents are using on a day-to-day basis?
Well, the answer is potentially. So take Prime Location, the last one you mentioned. I mean, that's a brand that's been around since 1990 something. And so it and especially within the M25, where it's very strong, has a very strong consumer loyalty to it. And if you think about, you're on the market, you're attacking Zoopla, you've got to get over these, the existing brands that are in people's heads. And we've talked about this in a previous podcast. Just because I've got a big checkbook with a whole chunk of money doesn't mean I'm going to win a market. Okay, what it means is I've got an opportunity to spend a lot of money, but am I going to really move the needle? Now, to move the needle requires me to convince you, Ed, that don't look at Rightmove anymore, look at on the market, or don't look at Zoopla anymore, look at on the market, because when you do that, you start generating leads that Zoopla or Rightmove aren't generating because their consumers aren't going to them. And then you're starting to create value for the advertiser that they wouldn't have got through another channel, is the way to think about it. Now, it takes a lot of marketing dollars to convince you, Ed, not to look at something. Because if you've been looking at it for the last 20 years, it's hard not to do it. And that's the real challenge, I think, for this marketing for all of them. Now, for Zoopla, they've got these brands. Zoopla's been around since, was it 2006?
2006, 2007.
Yeah, I remember meeting with Alex when he was setting it up. Alex Chesterman, who was the founder, at one of his offices before it even. So when he was actually doing the Zoopla estimate model, whatever they called it,
Zestimate.
the Zestimate, yes, and whatever, and he was telling me about it, what he was doing. And I thought, well, this is interesting, right? Because it's opening Pandora's box on the value of a home, and it's something that is clearly going to be very interesting to UK homeowners. And he executed well against that, and he built a very strong brand. So there's a lot of brand equity tied up in this business, a lot of real value that if you are on the market it's not a walk in the park. It's not like wake up in the morning, spend, what is it, £50 million or whatever they're spending on marketing, and lo and behold, you are now number 2 or even number 1. And the other thing to always keep in mind is when a portal spends heavily on marketing, what they're doing, it actually helps to rise all boats. It's like the tide coming in a bit. So Zoopla will benefit, Prime Location will benefit, Zillow, not Zillow because they won't benefit, but Rightmove will benefit in this process. Okay, not to the same extent as on the market, but they will also benefit. So it's not simple. It's not a very simple equation of throw money at the problem and you win. So I think, there's two issues here. One is there's a lot of innate value within the Zoopla company. There's probably a lot of distraction in there, doing the 30,000 different things that they're doing. And I think what will happen is that on the market will put pressure on Zoopla to really focus in on where the value is, and to really say, look, we don't need to do these 5 small little intellectually interesting businesses that combine lose us £5 million. We'll get rid of them, and we will take that 5 million loss that we were having and we'll put that into marketing. So you're just going to see a marketing war out of this, and the closing of a bunch of these small businesses within Zoopla. And then, if you, depending on the price, and I think what will then if you roll the clock forward, I think my hypothesis is that CoStar, via their investment in on the market, will invest. They will close the gap a bit to Zoopla. They won't easily overtake them. I doubt they'll overtake them, and eventually they'll probably make an offer to buy them. Okay, and that will be the most logical thing, to take the number 3 plus the number 2, so that you only have to worry about the number 1. And then taking on the number 1, and this is the other real issue, right, is that Rightmove's got 4 times the revenue of Zoopla and 3 times the traffic. I would be saying, how do I run a really profitable number 2? How do I get to that 50-60% EBITDA margin like Rightmove, just on a lot smaller revenue base, rather than trying to truly dislodge Rightmove in this process? Because I think you'll end up spending a hell of a lot of money and not going too far.
Okay, so that's Zoopla. The other CoStar owned challenger is Homes.com, which we've spoken quite a lot about. We've also spoken quite a lot about the leader in that market, which is Zillow. A real estate portal that we haven't spoken too much about is News Corp owned Realtor.com. Harvey, why don't you intro Realtor?
Yeah, sure. First thing. And one small thing, a small apology. I used the word Zestimate earlier to talk about Zoopla. That's a Zillow thing, unless I'm very much mistaken. So apologies for misinforming our
They're both real estate
listeners.
portals that begin with Z. They both
exactly. I mix them up all the time. Anyway, Realtor.com. So let's talk about Realtor in terms of Zillow just for a second. So while Zillow generated 226 web visits a month in Q2 2023, Realtor.com had 74 million. And for the 2 billion that revenue Zillow gets, Realtor gets 602 million. So we're talking about something that's around the quarter of the size, basically, just for, in layman's terms. Meanwhile, just like in the UK, CoStar Group is applying serious pressure upwards via Homes.com, as you mentioned, Ed, which is making things difficult for Realtor.com. Very difficult, in fact. 6 consecutive quarters of lower revenues, net losses, fewer web visits than its rivals, and it seems a little bit like it's a bit of an impossible competition, shall we say. Interestingly, the new Realtor.com CEO, Damien Eales, likened Realtor.com's situation to a knife fight. And my warning to Mr. Eales would be that its 2 rivals have much bigger knives than it does. They have a bigger reach, and they're having a pretty feisty battle between the 2 of them. I do worry that he might get hit in the crossfire, and I think this is a difficult position for Realtor.com at the moment. Back to you, Ed.
Thanks, Harvey. So the thing I want to talk about when it comes to Realtor.com and the challenge that it's facing is, and I think I wrote about this in a newsletter a couple of weeks ago, it's losing the PR battle, right? Now, the PR battle is obviously not the most important thing, but it is kind of important, especially when it comes to agents, right? So CoStar is able to say, we have had, I think it's 51 quarters of double-digit revenue growth consecutively. Wow, impressive. Whereas Realtor.com has had, I don't know, something like 6 quarters consecutive of double-digit revenue decline or something like that, right? CoStar is also able to say, and they don't have to do too much backing up of this statement, we are the number 2 residential network in terms of traffic, right? Now, there are nuances to this. CoStar's revenue, in terms of its residential revenue was something like 2% of total revenue in the last quarter, right? But people don't look at these nuances. They don't really care. And, when it comes to the traffic, they say we're the number 2 network of traffic. But again, they're not talking about a direct competitor to Realtor.com. These are PR lines that I think are probably going to resonate with agents in the US. Agents probably aren't going to dig too deep into it. What would you do, Simon, if you were in charge of Realtor.com to try and turn the tide of this PR battle?
Firstly, the NAR is highly involved in Realtor.com. Yeah, if I remember correctly. I remember actually, although the REA Group and News Corp own it now, I remember back in 2007, we put to the board of 2008, we put to the board of REA to buy actually Realtor.com and that the whole group. Okay, so I know, well, at least it's old news, but at least I know some stuff about it. The always the big challenge with looking at Realtor.com is that there is a deal in place with the NAR. So it's like there's operating as a license. Now that license has a lot of restrictions on what you can do. That Zillow.
I'm going to interrupt you there. I actually found the clause in the contract yesterday for this, which was quite a surprise. It actually says that the NAR may terminate the operating agreement for certainly contractually specified reasons upon expiration of any blah, 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 blah. If the operating agreement with NAR is terminated, the NAR license would also terminate, and Move, which is the parent of Realtor.com, would be required to transfer a copy of the software that operates Realtor.com website to the NAR and provide NAR with copies of its agreements with advertisers and data content providers. Essentially, if Realtor.com changes its business model to something that the NAR agents in America don't like, basically NAR ends up owning Realtor.com is how I understand that.
Yeah, more or less that's sort of what happens. So I think Harvey, the analogy of in a knife fight, I think they've got a knife in a gunfight, and it's not going to be pretty. Okay, and I think the real issue here is you have to be nimble, you have to do something different, and so on. Zillow is doing that. CoStar through Homes.com is going to try to do it. Okay, and they're clearly doing the old game of get content, get audience, generate leads, monetize the outcome because you've proven your worth, and they're going down that path. Now, what is both a bit of an anchor and also should be something that can really help the company is this relationship with the NAR. It's an anchor because you can't be nimble, you can't change your model, you can't do a whole bunch of the innovative things because you might, in that process, piss off the people that you've got this contract with. But at the same time, you should be leveraging the NAR, which is a very strong body in the US, one of the strongest groups, to really ensure that Realtor.com, the agent's site, is the way I'd be promoting it. Okay, the industry site. This is the industry site. So I'd be leaning into it and really fighting that PR game. No consumer cares about CoStar's double-digit 50-odd quarters growth. Who cares? They care that the website works and they can find a property. No agent really cares either, right? Because what they care is, I pay X and I get Y number of leads. They don't care how profitable or loss-making the company that runs it is. I mean, if they did, then why would they be spending their money on Zillow for all these years? It never has really made a lot of money in the process. They don't care. What they care is how big's the audience and how many leads I'm getting out of this, and do those leads help me close my deal? And what is it the mantra that Homes.com goes, your property, your lead. Yeah, you're listing your lead, right? And so on. So how do you as Realtor.com play that game? But it's like, okay, well, you're running that race. That race is getting some resonance. I've probably got more traffic than Homes.com. Okay, because I'm sitting here at what, a third the traffic of Zillow, and I would lean in to go, you know what? Yeah, you're listing your lead. Okay, so what we'll do is ... So I'd lean a bit into it. Clearly, they'll have to do it within what their relationship with NAR will allow, and I'll try to cut off some of that oxygen that CoStar is running with. But what this requires is I think that the real challenge when you take all the noise out of this, and I have no inside knowledge, but is probably a lot of time is being wasted internally at Move or Realtor.com on political conversations. Because remember, you've got News Corp on one hand, you've got the ARIA Group on the other hand, you've got the NAR on the other hand, okay, and you've got to manage all these relationships while competing with these other guys who have none of that. Okay, and they're just hungry and focused. If you can find a way to get rid of the noise and just drive aggressively in the right direction, then I think you'll keep CoStar at arm's length. I think if you can't do that, then you'll be like many of these businesses, you'll be gobbled up by bureaucracy and politics and issues that at the end of the day distract everything and allow CoStar to come running through. And if you look at I think CoStar's got a much higher chance of being successful in the US than it had to getting to number 2. I don't think it's going to take on Zillow in any sort of meaningful way of knocking them off. Then I think a much higher chance there than they do in the UK of being successful, because Zoopla has got one master, which is Silver Lake, who's going, I've got $3 billion tied up in this. I cannot afford to become third. Okay, for many reasons, right? Not only from the asset of Zoopla reason, but also Silver Lake backs winners. Okay, so from Silver Lake perspective, you've got to make sure that you deliver as well, because that'll impact their ability, to raise money and do a whole bunch of other PE type stuff in the future. So I think that's how I would be doing it. I'd be very much trying to put all the noise to one side, have a very clear strategy that in some ways takes the best of what Zillow is doing and the best of what CoStar is doing, because what all they're doing is highlighting underlying needs within the market, okay, and playing off them. And then leveraging my relationship with the NAR and leveraging the fact that I've got this brand, Realtor.com, that's also been around since 1990 something, okay, and is a super strong brand. That's what I'd be doing.
Okay. I think we'll move on to another number 2 real estate portal, this time not in a market where CoStar is trying to compete, but it does have an up-and-coming number 3 portal with a lot of money and a lot of industry clout. Harvey, why don't you tell us about Domain in Australia?
Yeah, absolutely. So, as you say, number 2 in Australia behind everyone's favorite REA group. An element of, we're quite successful, but where do we go next for Domain? Compared to the other number 2s we've been talking about, Domain gets healthy profits, it gets decent web visits, and it seems to have a high brand value, but it doesn't seem to be getting bigger, and it doesn't necessarily seem to be getting better. Struggling to grow some revenues outside the major cities of Melbourne and Sydney, I believe. And it also recently backed out of a mortgage offering product after $7.5 million losses last year. There was a rumor that was quashed, but a rumor nonetheless, that the owner of Domain, Nine Media, wants to sell part of its 60% stake. It's never good news when that kind of headline comes up, but as I say, the rumor was quashed. Domain seems to have mastered being a number 2, but there's no telling what's around the corner for it, as again, there is another, we're about to talk about it, another number 3 that's applying upward pressure with an immovable number 1 above them. Before I did my research, I would have ranked Domain as the strongest number 2, and I think I'm going to stick with that bet. But nevertheless, not all sunshine and rainbows over in Australia. So it's over to Ed and Simon.
Yeah, so Domain is actually under pressure as well from a number 3, View Media Group, which has been around for a while, but was taken over a couple of years ago by Domain's former boss, a guy called Anthony Catalano, and a guy called Alex Weiswitz, who's a billionaire businessman. And they've put a lot of money in, and they've been very vocal about, we are coming for Domain. We are going to take the number 2 spot. We're going to put pressure on them. A couple of questions for Simon. We'll start with, can you actually see 9 Media selling Domain?
Before I know Anthony very well.
You know everybody, to be fair.
Okay. Well, it's a small world. I know Anthony Catalano. In fact, I was having a beer on this very topic last week when I was in Melbourne with another former senior exec of Domain, having a chat about it. So the question, whether they sell or not is a separate question. The question is it really the valuation? Okay.
Yeah.
Because if the answer is, if it's a low valuation, why would you sell? If it's a high valuation, can you sell? Right? Because you're not selling 1% or 2%. You're selling a sizable chunk. And anyone knows anything about listed companies, selling a sizable chunk has to be an off-market transaction. And if you you've got to find someone who really wants to buy it and pay the price. So at the moment, based on my rough numbers, Domain is trading at about 6 times revenue. REA Group trades at 16 times revenue. Okay, vastly different. And then in terms of EBITDA, Domain is trading at 16 times EBITDA because it's profitable. It's doing about 100 million Australian dollars, EBITDA on a 300 and whatever million revenues. That's about 30 odd %. But REA is trading off 50 times EBITDA. Okay, and if EBITDA is your loose approximation for cash flow, what people are saying is that if you buy REA, it's going to take you 50 years of cash flow to pay back the value of the business. Clearly overvalued, right? Put it bluntly. So there's a lot of hope that they can continue to grow into like India and those other markets, because there's Australia. There's it's not an unlimited cap. It's not unlimited, sorry, in terms of growth.
Hang on, you're saying there's hope that Domain can grow into India?
No. REA with its investment in REA India. So that's where I think a lot of the growth belief is. Give you a comparison, in the UK, Rightmove is trading at 17 times EBITDA. So Domain and Domain and Rightmove are trading at the same EBITDA multiple. Okay, and both have been around since the 1990s. Okay, so that's probably a very fairly priced business. So it's not undervalued. It's probably fairly valued. I think the real issue for Domain is that it's losing some customers. It's not gaining customers against REA. And like Zoopla, is doing a lot of other things, a lot of other investments. If you look at their technology portfolio, there's a lot of other businesses in there, but they don't contribute much to the overall outcome. If anything, they're probably generating 10% of the revenues and operating at a loss. Okay, I can't remember the exact numbers, but I remember glancing at them last week. So given all of that, and if I was in the owners of Domain and I'm under pressure, I've got Anthony Catalano and his View Media Group coming up from behind, because they bought Real Estate View, another business I know well. You're looking at REA, but you're not going to take over REA. You've got to say, play to my strengths. My strengths are, I've got a very strong brand that's been around for 25 years. In some suburbs and areas, I am actually stronger than REA. In pockets of Sydney, especially the most expensive suburbs in Australia, in the eastern suburbs of Sydney, Domain would be stronger. How do you play to those strengths? How do you operate? Once again, maybe you end up with 300 million of revenues, but operating at a 50 or 60% EBITDA margin by becoming laser-like in what you do, rather than I'm looking for every revenue opportunity under the sun, and some of those are coming at a loss. So that's where I think that how you would do it. I certainly don't think they're undervalued, and they're not going to substantially grow the traffic versus REA, but I think they can become more profitable and potentially in selected markets close the gap. Now, this is interesting thought here. Right? If you go back to our conversation a few weeks ago about vendor paid advertising, okay, let's call it 35, 40, 50% of somewhere in that range of the Australian market is vendor paid advertising. That's where REA is making its money, and that's where Domain is making its money. In all the other markets, they're making a little bit of revenue, but it's certainly nowhere near as profitable. Because in the vendor paid advertising markets, it is the home seller who is paying for all the advertising. That's why they're paying per house, sometimes $5,000 and so on. If I was Domain, I would focus in on those strong markets to extract more value and dump all the other distractions because it becomes pointless. So, but that's a pretty obvious strategy. Execution of it's hard. Okay. But that way you will have more oxygen and you'll maintain that gap to View Media Group, which is trying to become the number 2 player, which I don't see really happening in that market.
Okay, why not? That's interesting. You probably know more about it than most. Why don't you see that happening?
Well, when you define what number 2 is, so you've got multiple dimensions. Are you number 2 in audience? Are you number 2 in lead generation? Are you number 2 in agents using you? And are you number 2 in revenues and profit? So there's 5 dimensions. You can think of what being number 1 or number 2 is. You're not going to become number 1 in audience. Too hard. If you look at the demographics of the Australian market, REA dominates Queensland. Domain has a marginal presence there. Queensland, Victoria, and New South Wales are the 3 major markets. Domain has some good strengths in New South Wales. Victoria, it's sort of REA, Domain, and Real Estate View. And then you go to Canberra, which is basically New South Wales, part of New South Wales. Domain is the dominant player with all homes there. Okay, so you can't look at one big country, you got to look at micro markets. To become overall number 1 player or maintain number 2 in audience, it's very hard because we talked about before, the brand awareness. So then you think about lead generation. Well, lead generation is highly tied to audience. So those two sort of go hand in hand. Number of agents, I could become number 1 with number of agents tomorrow. I just give it away. It's free. Give me your listings. It's free to advertise. Thanks very much. Hey, I'm the market leader in the number of agents and number of listings. Means nothing, right? Because there's no model off the other end. To then become number 2 in revenues and profitability is the hardest. Is probably the hardest thing because remember. REA and Domain are already built into so many of these marketing plans that real estate agents are walking around and giving to their home sellers. It's embedded in there. They don't have to do any selling. They don't have to say, "Oh, have you heard of this site called Domain? You should advertise on them." It's like, yeah, I know Domain. It's been here 25 years. It's in half the newspapers because of the relationship there, or it was in half the newspapers. And so on. But if you're then, you're the View Media Group and you're trying to do that in New South Wales, what brand are you going with? Okay, so you might become strong in Victoria, but there's far more to the world in Australia, far more to Australia than just Victoria. Victoria, New South Wales, and Queensland are the 3 that you want to be very strong with. Okay, and you just got to look at sites like Homely, etc., who have been in the market for a long time, poured a lot of money into marketing and advertising, have made some progress, but they're not threatening the outcome. Okay, it's just very hard to dislodge incumbents, is what it comes down to.
Okay, on that note, we'll sum up. If you had to choose one of the three real estate portals that we've been talking about today that you think will come under the most pressure, maybe even be overtaken, who are you going for, Harvey?
For me, I think it's Zoopla. I think it's a struggling business, and we don't hear much great news coming out of it. When we do get any PR, there's a lot of stuff going on in the UK at the moment. Rightmove is a behemoth. OTM's only going to get stronger. I think Zoopla's in trouble. That's my 2 cents.
For me, I think it's Realtor.com. I think at least Homes.com has a different value proposition when it comes to both agents and consumers. And well, for that reason alone, I think they stand a puncher's chance, let's say. Simon, what about you?
Realtor.com. And I'll give you I think Domain, when you're making $100 million profit already, you've got a lot of ammunition every day to fight with, right? So you wake up in the morning, you've got your bag, your pockets full of money. You can market, I can't see View Media spending hundreds of millions. You've got you're a listed company, so you could raise a bit more money if you wanted to, relatively easily, and you can outspend if you wanted to. I don't think you have to. Plus, you've got assets that you can get rid of that will give you more free cash flow because they are in more investments at the moment. Okay. If I look at, so I can't say that. Zoopla, I think Silver Lake's got too much to lose. I think there's a lot of embedded brand strength there. And I think On the Market is coming from too far back. Yes, they will take some of the agents, but I think it's still, you're looking at business that I'm sure if I got my hands on it, you could run profitably. Okay, I'm sure there's you've got 80 million of revenues. How come you were making? How come in 2018 you had 90 million revenues and about 30 million profit, and then here you are in 2022, you've got basically 90 million of revenues, 80 something, and you've got 10 million losses. Where is the other 40 million of costs come from? I'd get my scissors out and start giving it a big haircut. Okay. But I think Realtor.com is the one that is most at risk. And I think it's most at risk purely because of the convoluted ownership structure, politics. There's probably a as we spoke when we spoke with Brian Barrero a couple of weeks ago, the industry's being shaken up by lawsuits and so on, which will impact a whole lot of this MLS type structure. That creates opportunity. And I just don't see Realtor.com as being anywhere near as nimble or as entrepreneurial as they need to be to fight in that ever-changing environment. So if one was to go from 2 to 3, then I'd be looking at probably Realtor.com. And I would suggest, Ed, in a future little case study we should look at, and I'm going to suggest we get the guys on from Immobiliare, is to talk about how they took Immobiliare from a number 3 player to a number 1 player, beat Casa in Italy, and then how Casa ended up being gobbled up with Idealista, I think it is. So there's a fantastic case study. I know because I used to own, when I was at REA, Casa. So I saw how you go from number 1 to number 2. Okay, and it had nothing to do with the marketing dollars spent, etc. It had everything to do with one side becoming distracted with politics and the other one being super laser focused on an outcome. Okay, so there's an interesting case study there.
That's a good place to end it. Simon, Harvey, thank you very much for your time. And until next time, until we potentially talk about that case study.